The Icons of Real Estate Podcast. Are you ready to learn the proven money-making secrets from top-producing icon agents? Ready to skyrocket your business? This podcast is for you. Tune in every week with your host, Tomasz Fonseca, and find out how to implement proven strategies to 10 times your business, from $3 million to $30 million in just 12 months. Brought to you by the Masters at Real Estate Marketing, Arter SEO.
Welcome to the Icons of Real Estate Podcast. I'm your host, Patty Teal. Today's guest is Taylor Loht. He's the founder of NT Capital and host of the Passive Wealth Strategies podcast. He teaches the professionals how they can invest in real estate without the headache of being a landlord. As a busy professional himself, he understands the importance of learning investing strategies. He has partnered in over $50 million in multifamily and self-storage investments through tax-advantaged retirement accounts. Welcome.
Thank you so much for having me today.
Oh, I'm so glad to have you today. So what we usually start with, Taylor, is learning a little bit about your story and how you got to the point you are right now. So would you mind taking us through that? I don't care if you start when you're a kid or a few years ago, but whatever led you to this line of work.
Sure, absolutely. And I probably need to update that number. It's that instead of 50 million, it's like 150 million now, but I need to go through and update all my bias.
That's much nicer, yes.
Yeah, so but it's important not to get blown away by those numbers, right? It all comes down to the fundamentals. But anyway, so I usually kind of start my story when folks ask at graduating from college and getting my first big boy job and having a few nickels to rub together and seeing, hey, how can I turn this into more money, right? I didn't want to trade hours for dollars for the rest of my life. I figured I might as well try to earn more. I've always been kind of good with my money, good at budgeting, all that kind of thing. Never had that problem. So first book I picked up, first place I started learning was a book called The Intelligent Investor by Benjamin Graham. It's the book that kind of informed the mentor that shaped Warren Buffett and started his value investing strategy, essentially. That's about publicly traded securities. So that's how I got started as an investor, was just in the stock market. And frankly, by being lucky, simply by my age, I just so happened to time the market very well and graduated from college, at the depth of the Great Recession. So it's hard to throw a rock and miss a bad stock at that point. Although it's definitely possible, but focus on value. I think there were a lot of good opportunities. But fast forward a few years, and I was, doing the math. I have, backgrounds in engineering, so I like doing the math, and investing is a very, math-driven concept. And I was seeing that, okay, this isn't going to get me where I want to be. I had a pretty good idea of where I wanted to be, and I could see that the math didn't add up. It didn't get me there in the time frame that I was interested in. So I started looking for other ways I could make money, other ways I could build my wealth, was really what it came down to. And explored a lot of things, a lot of entrepreneurial ventures, worked a long time on getting an MBA. I didn't actually go to get an MBA, but I did everything on the front end. The big problem was, the big turning point, maybe not the problem. The turning point was, as I was applying to schools, I just so happened to, as I was listening to real estate investing podcasts, picked up a book on a recommendation by some podcast called Rich Dad, Poor Dad. And that highlighted every misgiving I had about spending $300,000 to go get an MBA that was going to get me a job I didn't really want to do in the first place. Make a lot of money, most likely, but at the end of the day, it's not something that you want to do, and it doesn't build passive income. It also taught me the value and the importance of building multiple streams of passive income. So that really shifted my thinking and got me started down the path of investing in real estate, and turned my stock investing focus into a real estate investing focus, and started gobbling up everything that I could about how real estate investing works. I think most of us out there, when you're kind of more broadly interested in investing in general, you don't know how real estate investing works. If you're going to go buy a stock on the market, there's nothing you can do with that other than time your purchase. There are options and everything. You can add some strategy to it, but you cannot, if you're buying a stock, you can't add value to it. You can't proactively change that stock's value. Now, it's one thing if you're a control person, maybe you can make some changes there, but for the average person out there, you can't drive the value of your investments, but it's completely different with real estate investing. I learned we can buy undervalued assets and use creative financing to buy them and use other people's money to buy them and build passive cash flow. And I was, immediately hooked. And that was, I don't know, 2014, 15 or so. And ultimately started learning about bigger multifamily investment deals, learned about real estate syndication. This is fast forwarding quite a bit. And I knew that is really what appealed to me the most. That's a strategy that I wanted to do. So spent years building a brand, building my knowledge, building a network, and started having opportunities to partner on deals and close deals, sell deals. And now I focus on raising capital for real estate syndications.
Wow. I am so impressed with your journey at your young age. I mean, and I am on a daily basis. I just talk to the most interesting people. I swear, when I was, your age, it was the furthest thing from my mind to make money. Do you think it's a sign of the times that people are so business oriented at this day and age, or do you think I was just hapless? So you don't have to answer that part of it, but it does seem that young people nowadays are very focused on where they're going to end up. I mean, they already start thinking about retirement.
Sure. I don't talk about it publicly all that often, but I'm, so I'm not that young. I mean, I'm 33, right? I'm not looking at 40 is the next big birthday, right? But that's
you're still 7 years away.
Yeah, right.
I'm pretty good at math.
Hey, I'll tell you, I remember 7 years ago, right now, like it was yesterday. They all go faster. That old chestnut, right?
Time goes faster and faster. Yeah,
sure does. So I think I can only speak for myself, of course, but a big formative experience in my generation's lifetime, my kind of cohort's lifetime, was the Great Recession. It was a big financial crash. Sure. Yeah. A lot of our parents either struggled to keep their jobs or lost their jobs and had, financial struggles. And fortunately, we were okay. My parents worked very hard to, make sure we were taken care of. But still, you're in that environment. You're seeing those things happening. When I was in college, the job market, and I was getting a chemical engineering degree, very marketable, but still I was seeing people a few years ahead of me, some of them struggling to get jobs. And I went to a top 10 university, not to brag. I'm a crappy student, but
you're an engineer. You got a good head on your shoulders.
But I think you can't look at people my age and really subtract out things like the Great Recession. I mean, everybody experienced that in their own way. But I think that informed a lot of the way that we think about our personal finances.
Right. So are there some basic principles when you talk about investing and passive investing?
Absolutely. I think we should all start with knowing our goals. Your goals are, I think, everything when it comes to deciding what your investing strategy is going to be. No matter whether it's real estate investing or stock and bond investing, no matter what you're investing in, know your goals and start learning, getting into what you understand. You need to build an understanding of what you're investing in. When you get into the real estate specific investing space, that's when I think your knowledge and your network become so much more important and critical. It's not that difficult to set up, if you're an index fund investor, set that up, send your paycheck straight to it and you're done. Just wait 30 years and you'll have those investments.
That's a long time.
It is a long time. But as a real estate investor, you can't do that. You have to go find the deals. You have to evaluate the deals, find the partners, all those things. And so your network and knowledge become so critical.
Yeah. And earlier you mentioned the added value that you can do with real estate. I mean, with stock, you can kind of get lucky on the timing, or you can pick a good stock. But how do you add value to some of the properties that you've invested in?
So I invest in commercial real estate. Commercial real estate being multifamily over 5 units, or other types of commercial real estate like self-storage I invest in. There's also retail, industrial, office, all those kinds of things. But I focus on large multifamily, generally over 200 units, and larger self-storage properties. And there are 2 ways to raise the value on a piece of commercial real estate. And that comes down to how the properties are valued. And there are two components to how commercial real estate is valued. There's the net operating income, which is the income after all the expenses are paid, not including the debt. And then there is the capitalization rate, which is kind of the market's metric for what they're paying for free cash flows. We can't drive the cap rate. We can look at it in our underwriting. But the two knobs that we can turn when we buy commercial real estate are the income and the expenses. We can raise the income, we can lower the expenses. So lowering the expenses is significantly more limited. You can only get so cheap when you're doing, making physical changes to a property. You can, sky's the limit for how much you can spend on an appliance, a washing machine, whatever. But you can really only get so cheap until you have a non-functional. Right, exactly.
So somebody has to live there. Cute kitty.
Right. We got cats and they like to walk across my desk.
That's okay.
So raising the income, there's obviously raising a rent is a big part, but we don't want to just buy a property and raise the rent. We want to improve the property, improve its operations, offer more value to the residents. And those are the two things that we do. And the actual execution of that strategy is different in multifamily versus self-storage versus any other commercial real estate asset class. But that's at a high level, the basic idea.
It seems like it must be a really good time for multifamily with rents being as high as they have gotten. Is it particularly good?
So I think it's actually a difficult time because rents are very high, but valuations are very high too. And there's a bit of a nuanced aspect to it that 5-10 years ago, the spread between Class A assets, which are newer, nicer assets that rent for more, versus say Class C and Class D assets, which are older properties that don't have as nice finishes and rent for less. The valuation spread between those has gotten narrower and narrower. So the cost that you pay to buy a higher end property compared to a quote unquote lower end, lower valued, lower rent property, that's actually gotten skinnier. So it makes less sense to say buy a quote, cheap C-class property and fix it up. A lot of investors have been, myself included, have been driven higher into B and A or A and B asset classes because that's gotten skinnier. There's also the purple elephant in the room, if you will, of the financing market, interest rates going up, a lot of lenders kind of pulling out of the market. And those are all factors that play into any, real estate investment, not just including, commercial.
Well, that's curious that gap has gotten smaller between the nicer properties and the lower cost properties, I shall say, or the price has gotten closer. Why do you suppose that is?
There's a lot more capital chasing deals. There are a lot of people that are interested in real estate investing. There are different opinions about this, but generally speaking, I think real estate is considered a very good hedge against inflation. If it's done correctly, inflation's still going. People want to get out of the stock market, and especially in multifamily. So in the real estate space, there are several asset classes like we discussed before, and everybody's working from home now. Now, some people are going back to the office, but I think work from home is here to stay, hopefully in the long run. I think it's a good thing, but that means that investors know that too. So people who used to invest in office, at least some of that capital that was focused on office and at least some in retail investing, that's looked for other places to invest. Now, undoubtedly, some people have gotten out of real estate entirely, but I think that's probably the minority. I think many of those office investors, especially bigger money folks, are really refocusing on multifamily because people need a place to live. We're not building enough housing in the United States, no matter how you slice it. Most markets are short of housing now, just based on the break that we took of building new real estate in the wake of the Great Recession. Plus, just general growth patterns. And so it's multifamily, especially nicer properties, are going to remain a scarce asset into the future. So I think that all adds up to more people just being increasingly interested, in real estate and multifamily in particular.
So I know nothing really about the storage unit business, except for I've been in cities where you can hardly find any storage units. I think they must do a really good business, and it doesn't look that tough. But really, I know nothing about the ins and outs. Can you describe the advantages to investing in storage units and how that makes a return on your investment?
Sure. So a big one that comes up when you're talking about just owning a self-storage property is that
Mhm.
there's so much more straightforward to manage than a multifamily property. And that just makes sense on its face when you think
Yeah.
about
Nobody's
managing
living
people's
there.
homes. Nobody's living there. It's just their stuff, right? And
Mhm.
there are a lot of tools and pieces of software that are very available now that you can use to run a self-storage facility so that, yeah, you might, depending on the size of the facility, you might have an office that's staffed either part-time or full-time, but that can be one person, not
Mhm.
a staff, a big maintenance crew, and all kinds of people doing work. So the management is a lot more straightforward. Additionally, we can't in this day and age, right? We had something unprecedented happen within the last couple of years. Of course, the coronavirus pandemic was, and hopefully we're on the tail end of that. But in addition to the pandemic, there came the eviction moratorium, and we all dealt with that in our different ways. Fortunately, there were programs available, and but the precedent is set that that's there. So you're going to deal with that in multifamily, or we did deal with that in multifamily, and hey, who knows, that might come back in the future. But when you're dealing with storage, that's just stuff. It's not landlord tenant law, it's lien
Sure.
law. Now, that doesn't mean you can necessarily, if somebody doesn't pay, just cut the lock off and kick them out. There are different state laws around what you can and can't do.
Mhm.
But still, that means less complexity, less issues with collecting rent. More automated facilities will automate their rent collection. You put on a credit card, put on automatic bank debit, things along those lines. So that all simplifies the process of actually operating a self-storage facility. Self-storage is also a lot more fractious than multifamily, or a lot, maybe the better way to put it is a lot of the ownership is less sophisticated in terms of how they manage the property. And I kind of hate to say sophisticated, but less up to the times in how they manage the property, meaning that there's a lot of mom and pop ownership, and they're
Sure.
perfectly happy to collect rent in cash, not kick people out when they're not paying for their self-storage. Hey, fine, take a couple days to get it to me. They're perfectly happy to leave folks at the same rent on their self-storage unit for sometimes years on end, not keeping it current to market. And that's fine for the mom and pops because they really care about cash flow. They don't necessarily care about maximizing the value. But that means those of us who do care about maximizing the value can capitalize on that opportunity when mom and pops, decide to sell their facilities. So
Mhm.
just a ton of potential if it's done right. There, depending on the market you mentioned, it can be hard to find a storage, and there can be a lot of reasons for that. But in the case that it is hard and there's not availability, that means there's a lot of demand. It's a little more straightforward to develop self-storage. Now, some municipalities are kind of turning against self-storage in a way and kind of permitting fewer new self-storage facilities. Some markets are a little oversupplied. It's all very location dependent, 1-3-5 mile drive type of things. But if you have an existing facility that's completely full, maximizing rent, and there's no storage available elsewhere, if you have a little extra acreage on that property, build more. It's a lot more straightforward to build more storage. So there's a ton of potential if it's done right. Like any type of real estate out there, it's at all-time highs. So there certainly are risks involved, but operationally, I think self-storage has a lot of strengths.
Right. And it seems as though, from my experience as having storage units, because I have too much clutter, not because I'm an investor, but one that I have in Colorado, the rent is, I think, $85 a month. And the one that I have in Santa Barbara, the rent is $300 a month. So
Wow.
10 by 10. And so it leads me to believe that, the property values really have a lot to do with the storage costs. Is that correct?
Well, yeah, I mean, it all feeds in, right? If it's more
Mhm.
expensive to develop, and I imagine it's a lot more expensive to develop anything in Santa Barbara for a lot of reasons. So I got another cat coming up my
I
desk
just
here.
love that. It's keeping us
Weird.
entertained.
But if it's expensive to develop any piece of property in an area,
Mhm.
that's going to push values up. It kind of doesn't matter. There's probably also a lot of demand in Santa Barbara. Probably also more difficult to get a new facility permitted in that area.
Mm-hmm.
So there are a lot of factors that can, go into that, situation.
Right. Okay, that makes sense. Now, if somebody wants to begin investing, can they start as a passive investor, or would you recommend they start as a hands-on investor? And what are the advantages of going each way?
So can they start as a passive investor? Yeah. I mean, I did. I'm an example of somebody who did that. Now, that doesn't mean that's right for everybody. I had funds saved up. I had investing experience. I studied how these deals work for a long time. I didn't just dive into it. I didn't invest, I didn't go look for a deal and then boom, invest in it. I worked for a long time to be confident in the decision that I was making. So yes, it can work, but that's not right for everybody. Some folks want to really dive in and get their hands dirty. I think it really comes down to, excuse me, it really comes down to knowing yourself, knowing what's right for you, knowing what's going to get you started. How are you going to get into it? I think to go back to, if you're talking about somebody who's very early on in their investing career, they're younger, they're a little less settled down. Maybe they haven't bought a house yet, but they're considering it. Now it's a very competitive market. We just bought a house ourselves. So trust me, I know. But if you're in a kind of stage of your life where you could buy a house and have roommates and you're comfortable with that, man, do that. You're going to bring in plenty of cash flow. If you do it right, but has big potential to, you could live for free if you
like a house hacking situation.
House hack.
Yes. Yeah.
So know yourself, know your situation. I think there's no right answer. There probably are wrong answers, but it's so heavily dependent on the individual, I think is the truth.
Passive investing sounds just lovely, sitting back and having your money make money. But I suppose it's really a huge decision who you choose to invest with and what company you go with, and how would somebody make that decision?
Yeah, absolutely. I mean, that's a huge decision. And most of us in the space, our first question when you're talking about a deal is, who's the operator? Who's running the deal? Who's making the decisions? What's the team? Do they know what they're doing? Have they done this before? I mean, those are real big questions that we're going to ask. Now, my mind is brought to a recent Bigger Pockets thread. I don't want to get too specific about this, but somebody was asking about, hey, my friend I've known for 10 years is doing this syndication deal. And he threw out a few things about the deal, including some return metrics that I'm not going to repeat, but they were really high. And my first response to that is, have these guys done this exact type of deal before? One. Two, that return projection that I'm not saying publicly, but in my judgment, it was much higher than most deals in the market today. Is that realistic, and why? And do you, as somebody who's considering this as an investment, do you believe that that is viable? And one of the things that I said is, do you think that's a conservative projection? My stance is, I don't know anything about this deal, but I really doubt it, because the number they said isn't a reasonable prediction for kind of any real estate deal that you're going to raise money for these days, because the market has a pretty narrow-ish band of potential returns. If you're way outside of that on the high side, then are you smarter than the market? Did you really find a diamond in the rough, or are you kind of doing your math wrong and being a little rosy, right? I would rather go for a middle of the road deal, base hit, and potentially overperform, but you only have to hit base hits over and over and over again to build a lot of wealth. So the team, is it a reasonable deal? Is it conservatively underwritten? And not just, does the sponsor say it's conservatively underwritten? Because they all say that. Everybody says that.
That's just the buzz line, huh?
Right. Everybody says that. And this person said that. It's one of the questions I had is it conservatively underwritten? He said, well, my buddy says it's conservatively underwritten. Like, everybody says that. Do you think it's conservatively underwritten? So those are the first couple of questions that I ask. It's important to know your relationship. We go through a lot of hoops to vet the operators that we work with. Securities licenses. We send people on physical due diligence trips. We background check all the sponsors. There are a lot of ways to mitigate some of that. Things like bad actor risk. You can't mitigate every risk in a real estate deal, of course, but you can, in my opinion, take a lot of steps to mitigate those things. And I'll tell you about a deal that I invested in that actually went wrong as a passive investor in a deal, and was comfortable with everything, the setup, the sponsor, they'd done it before. They'd worked with the property manager before, all these kinds of things. They'd invested in the market before. Check. Well, a little while in, might have been a year into owning the properties, the main operator discovered that the property manager was maybe stealing money from us. We weren't really sure what happened, but it didn't look good.
Right. Yeah.
And there's some missing money, and the explanation is probably not good. So he immediately terminated the property manager, which is great. That's what you do. But the twist was that the property manager was also a general partner in the deal. He also had general partnership shares, which is oftentimes presented as an incentive. Hey, we're going to give this to the property manager to incentivize them to overperform. And I've seen this happen many times, actually, not just in my deal, but in friends and colleagues' deals, that setup less often incentivizes outperformance and more often incentivizes underperformance, because they think maybe not deliberately, maybe subliminally, but they often end up thinking, I can't get fired from this. I can do kind of whatever I want.
Yeah.
And fool me once, shame on you, fool me twice, shame on me. I won't get fooled twice about that. And I think that's one of the nuances. I don't think property managers should have kind of quasi third party status. They can either be vertically integrated into the operator. I think that's a good thing if they do it right, or fully third party, but not kind of third party, second party, first party thing. Don't mix it up. You want to be able to fire them as part of your business plan if you need to. There's a few things that I look for, and a few ways that I look to mitigate risk when I invest.
Well, live and learn, and that's a good lesson. We've all had some like that. But I'm imagining myself as a new investor, and obviously I trust you. I can tell you're just very honest and trustworthy in your businesses. But if you went with the wrong company and they gave these projections, I could see falling for it hook, line, and sinker and going, I made a big mistake. So do people hire someone else to look at deals for them when they're uneducated, or what would you suggest?
Yeah, there are groups out there of groups of just passive investors that you can find by going on Bigger Pockets and other forums, that all they do is look at deals. They're just passive investors who the goal is in that to mitigate the risk that you're going to get somebody in there, promoting their own deals, and be able to evaluate deals together and make decisions together and learn together, which I think is a positive thing.
It is a positive thing. So, where do you find your investors and your investments? All over the place? Just always watching?
So we'll start with investors. So as you mentioned, I have my podcast. Now the podcast is it's not like an advertisement for my business. I only briefly mention my business. It's first and foremost education. Most of the time we don't even talk about the types of deals that I do. Now, I never talk about my own deals in the show ever, but we talk about multifamily and self-storage, of course, in educational terms, but we'll talk about flipping, burr investing, all that kind of thing. And the goal is to add value, add education, help people learn and develop their own tool sets. And if people want to talk to me, great. Awesome. If not, that's fine too. I hope you enjoy the show. I'm very active on Bigger Pockets, so people find me through there. I host monthly webinars. They're free, educational, really just to help people learn. Again, it's not me talking about my deals. It's sharing information about a particular investing strategy. Sometimes with mobile home parks. I don't invest in mobile home parks. It's just education.
Right.
Prior to COVID, I hosted an in-person networking event every month. That's been on hold, obviously, but we're working on bringing that back. I've got a little kind of partnership form, so we're working on bringing that together. But it's about building a network. Real estate, no matter what, is all maybe not all, but it's a large who do you know type of thing, and how have you added value to them?
Yeah, I've heard that a lot. And where are you located?
I'm in Richmond, Virginia.
But Do you invest all over the country or do you stick to a certain area?
I invest all over. So our model is a little different than a lot of folks. So I have securities licenses. So we work with operators around the country to help them raise capital for their deals. And our focus is on building long-term relationships with our investors and with our operators, because I invest, we have a vested interest in the performance of these deals, not just because we're placing people's money in. I invest my own money, like we're investing these things. So that allows us to invest in a wide variety of markets, mostly the Sun Belt. I think that's where the best markets to invest are mostly located. Not 100%. There's some Midwest markets that are viable, but I mean, I like Phoenix. I like certain parts of Florida. I like the Carolinas. I like certain parts of Georgia, Texas. Those are just a few places where we invest.
Yeah. Well, that's fascinating. So you're pretty spread out and you're just always looking for those great opportunities that are either brought to you or you find them yourself.
Yeah, that's right. I mean, it's all about, again, going back to those relationships with the sponsors. Is like when they, have a deal, then, great. We look at it and evaluate it and see if it fits, if we like it, and then we'll move forward.
Interesting. So what are your goals moving forward?
Like esoterically, personally?
Well, you can share both. I actually was thinking more in the real estate, but I'd like to hear your personal goals too. That would be fun.
Yeah. So first I'll start with the real estate. I mean, goal in real estate is just to keep scaling, keep building wealth, keep everybody likes to talk about 10xing their business. I think that's a great goal. And I'm certainly on that trajectory. But I think the number on its own shouldn't be the focus. The number should be to do quality deals over time repeatedly and just focus on executing. So that's the goal there. Personally, I'm getting married in April. We bought a house, keep going. So, just keep doing it, keep going to real estate investing events, and keep enjoying the business, because ultimately, I think it's another thing. I hate to say my generation, but
that's okay.
I have a feeling, and maybe it's an intuitive thing, maybe it's BS, I don't know, but I think we tend to be a little less materialistic than folks who came up a little bit before us. Maybe not, but it's not about that. I mean, I have charitable causes I support. I'm a big animal advocate. I donate to animal shelters. So once we hit a certain point,
I do think there has been a huge increase in like cause-based businesses where a portion of the profits go to some wonderful cause that people really feel strongly about. So
yeah, and I've had conversations with my mentor about that, and how can I kind of more lump that in with my business. His opinion was that doing that, as it feels like, his quote was, it feels like transactional philanthropy, which I think is an interesting take on that. I don't want to see him that way. I do it to do it because I think it's the right thing to do.
Yeah.
So I'm still figuring that out, but
as long as it helps the animals, that's what's important, right?
That's the goal, right?
I can tell you're a cat lover. What other animals are you trying to help?
So I mean, I donate to animal shelters that mostly have like dogs and cats, primarily.
Yeah.
We'll see once we branch out. My fiance's goal is to have a little farm and rescue basically farm animals. So we'll see if we get to that
who
point.
knows? You'll have to
move
keep
again.
us posted on that. That sounds wonderful. Yeah. Well, thank you so much for being our guest on the Icons of Real Estate podcast. I thoroughly enjoyed talking with you today.
Thank you for having me. It's been a lot of fun.
And I don't know if I asked for contact information. So very important.
So you can, or your listeners can reach out to me, my company, ntcapitalgroup.com, my show, the Passive Wealth Strategy Show, Passive Wealth Strategy Singular. It's just one.com. We have a free video course. I don't know if I can put that out there for passive investors. Yeah. 7 red flags in passive real estate investing. Now, it's not everything that can go wrong in a real estate deal. That would be impossible to quantify, but it's the top 7 things that I see go wrong in real estate deals. Available at passiverealestatecourse.com. Pretty straightforward video course, walking you through, again, top 7 things that I see go wrong in real estate deals.
Well, I'm going to check it out. I hope our listeners do too. Thank you so much.
Thank you.
Bye.
Bye-bye.